July 31st at 9 p.m. Eastern, 6 Pacific on Report on Business Television.
It's a microcap with a small float that's controlled by its founding shareholder, and while its business is based on real estate, it's not going to pay you a dividend. So why should you be interested in Main Street Equity? Let's find out from Bob Dillon. It's its president and founder. Thank you for being here.
Thank you, Amanda.
Those are some of the, not to be rude, those are some of the questions raised by analysts in a research note that I read. Microcap, no dividends, not a REIT, don't think it's a REIT. But they conclude, actually, there's quite a favorable note, that there's lots of upside here. So why don't we start with what it is you do that's creating this opportunity? What does Main Street get up to?
First thing I want to touch on, Amanda, is the overview of the real estate multifamily market. We haven't had new supply for 25 years. Most of the supply is tired, needs lots of work, fragmented, mom and pop. That's the first thing. Second thing is the market trades at 50% of replacement cost. If I can define replacement cost, it's product. If I went out and a developer build a brand new apartment building tomorrow, it's going to cost you twice as much as buying his existing stock.
Yep.
So the fundamentals are rents have to reach a certain level before new construction of apartment buildings will happen.
So the art for you is raising your rents not quite to that level, well, but just shy of it.
I have a unique opportunity within this opportunity. Like I said, the first driver of our business is buying below replacement cost.
Yeah.
It's the only segment that trades below replacement cost with 45-year low interest rates, which is the biggest cost to us.
So in terms of we should say you're capitalizing on the Alberta market. Now you are in other places as well, but you've got a lot of business there, and that is a red-hot market. And I think that it's the ability to raise your rentals in that market that's really going to drive your near-term growth.
We are the king of mid-market, right, which is below the radar screen of institutional players. All the big funds, the institutional players, the REITs, whatnot, usually buy 35% of the market, and the 65% is my mid-market. How I define mid-market is buildings generally below 100 units and buildings generally that need repositioning. How I describe repositioning is by increasing the revenue by renovations and decreasing operating costs through technology.
And in terms of the risks to the story, if we just look at the assets you have now, you refurbish, you raise rents. If a market should go sour on you, and I guess then we'll come back to Alberta, where right now it's so strong it's hard to picture, but it certainly could crash if there was some kind of major correction in commodities, and the real estate market could correct on its own. What happens to you? How are you protecting against that downside risk?
There's two risks in our business, supply and interest rate. I've talked to you about the supply, buying below replacement cost. We're fixing everything in long-term interest rates and mitigating the risk of interest rate hike.
Yeah.
I don't see what other risk there could be because our cost base is so low because we buy in mid-market, we buy in buildings that we are repositioning, and also we are a service provider. So in a downward cycle, all the other mom-and-pop, fragmented mom-and-pop will not be able to compete with our renovated products with supply. And service.
Does that in fact create an opportunity for you to increase your portfolio, to buy from those people as things like interest rates move against them?
Yeah, like I said, we've been growing 50% every year for the last 7 years, and we didn't have the Alberta boom. And my background is a real estate entrepreneur, and I've always thrived in a down market than an up market. This is a little bit of a bonus, like 35% increase in rental revenues in 90 days in Calgary is unbelievable. But that's not what our business model is focused on.
Yeah.
It's just a bonus we got.
Let's address this issue, the microcap, the very small float controlled by you. Can you address that? Will you be issuing shares? Will you be increasing the size of the float anytime soon?
That's a really good question. First of all, I think I'm one of the few stocks on the real estate index that trading below NAV, net asset value. So till my value of my stock goes up considerably, which is quoted by two other research analysts, National Bank and Desjardins, Frank Mayer and Jimmy Shan, clearly state that my NAV is considerably higher than what my stock's trading. Although my stock has gone up 100% in the last 6 months, but still we're trading below NAV.
We're looking at the stock. It's it's certainly a ride to the upside here. Is it possible, though, that you're trading below NAV because of some of those structural things, like the size of the float, like the fact that you're microcap? Could you find out that that would correct itself in valuation with a big offering?